There's 7 very important factors that are screaming bad things to come for the stock market. And I'm going to run through them right now. So this is a chart of the S&P 500 during rate hiking cycles, which means when the Federal Reserve hikes interest rates. And as you can see, every time they do this, it puts pretty much immediate pressure on the stock market, sometimes causes an outright crash. Now there's so much debt in the system right now that we went from 0 to 0.50 since March of 2022, and it's already caused the S&P 500 to go down almost 20%. And the Fed is going to try to get to 2% interest rates by September. You tell me what you think is going to happen. This is a chart of margin debt. So when rates go very low like they did for the past 2 years, there's always a giant amount of margin debt taken out, which is basically just the term for borrowing money to buy stocks. So as you can see, this red line is the amount of margin debt and the blue line is the stock market. So you could see they rise together, and whenever the margin debt starts being reduced, it immediately causes the stock market to go down because margin calls happen. And you could see here that's at 772 billion right now. In January, it was at right about $1 trillion. So you could see they're pretty much in correlation. Now, the scary thing about this is that when margin calls start happening, it creates this doom loop effect, because in order to cover your margin call, you have to sell stock that you own. So it's a very fast cycle once it starts picking up momentum. This is the Warren Buffett indicator that is very popular among investors. It measures the market value in comparison to the overall GDP. And the way this works is that basically whenever the stock market is underneath this line, it's considered a good time to buy by Warren Buffett standards. And whenever it's over this line, it's very overvalued. So as you can see, we've been over this line for a long time now. This is the Federal Reserve's balance sheet in this orange line right here compared to the S&P 500. Now, the Federal Reserve's balance sheet means how many US Treasury bonds they own. And the reason this moves so closely with the stock market is because when the Federal Reserve buys government bonds, it means they're adding liquidity to the system. And the more liquidity in the system, the more money there is to buy assets. And conversely, when the Federal Reserve sells treasuries, it's called quantitative tightening. You probably heard of the term quantitative easing. That's when they buy treasuries. So right now, June 1st, they officially started their quantitative tightening cycle. So every month going forward, they're gonna reduce their balance sheet by $90 billion per month of US treasuries and mortgage-backed securities. And as you can see, that's pretty much always stock market negative. This is a chart of what is called yield curve inversions, which means when the short-term 2-year treasury interest rate goes above the 10-year treasury interest rate. And the reason that happens is because a disproportionate amount of money leaves the stock market and buys these long-dated treasuries in fear of a stock market recession or crash. And when you buy bonds, it pushes the interest rates down. So these circles are when the yield curve inversions happen, and then these red bars are when the stock market crash or recession happens. And we had a yield curve inversion earlier this year. This is the University of Michigan consumer sentiment chart. So as you can see, we are approaching the 2008 lows. This 2011 downturn is when commodity prices got extremely high. And finally, this is a quarterly chart of the United States GDP. So in Q1, GDP receded by 1.5%, and in technical terms, 2 consecutive quarters of negative GDP growth is a recession. So it's possible that we are in a recession already. Hate to be the bearer of bad news, but ignorance is not bliss, especially when you're talking about your life savings. Hope this helped. And this is not financial advice, just financial awareness.